Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Circle Internet Group, CRCL. Following its highly anticipated June 2025 IPO, it has just been a masterclass in market confusion. We are talking about extreme volatility. The stock saw a parabolic ascent to nearly $300 a share right after listing, only to collapse in this vicious 70% correction. Today, CRCL is trading around $79.30, and its market cap is hovering just under $19 billion. The market simply does not know how to value what it owns.
And that identity crisis, right, that's what's created this massive price swing. And it's the central issue we need to tackle. Does the market see Circle as this, massive low multiple interest rate arbitrage vehicle, basically a giant money market fund that writes some code, which is incredibly vulnerable to macro shifts? Or is it truly the high multiple B2B utility and digital infrastructure platform that the bull case absolutely requires it to be?
It has to be the latter. So the central question for us today is whether that current price, $79.30, represents a fundamentally dislocated asymmetric opportunity based on CRCL's long-term infrastructure play. I firmly believe the market is mispricing the company's pivot, ignoring its transition from an interest income proxy to a high-margin transaction service platform, specifically the Circle Payments Network, CPN, and ARC. This makes the $75 to $80 zone a strong entry point.
I'm sorry, but I just don't buy that. The extreme volatility reflects a structural overvaluation and financial fragility, not simply market confusion. That forward price to sales multiple sitting somewhere between, 7.6 and 10.6 is completely unsustainable given the risks. The stock is still dangerously overvalued and structurally exposed to immediate financial headwinds, most notably the impending rate cuts from the Federal Reserve and a severe technical supply overhang that just emerged last month.
Well, we have to look past the current financial statement and focus on the architecture they are building, because that is where the sustainable long-term economic moats are created. I argue that Circle is building the foundational software layer for the next decade of digital finance. USDC acts as the M1 money supply for the digital economy, and consequently, Circle operates in effect as the Federal Reserve of the Internet.
Simply holding T-bills. Where is the tangible proof of this B2B utility?
The proof is in the enterprise integration, and the Intuit partnership is the definitive proof point for this whole B2B utility thesis. By embedding USDC rails directly into platforms like QuickBooks and TurboTax, they are moving beyond crypto speculation and into essential corporate finance. They are bypassing the 1 to 3 day settlement times of the legacy banking system. This is pure, sticky infrastructure revenue, a new economic OS facilitating instantaneous, high-margin corporate transactions. You are not paying for interest income here, you are paying for speed and certainty.
Okay. I recognize the strength of the Intuit deal for the long term, but to understand its current $19 billion valuation, we must ground ourselves in the financial reality of Q3 2025. When we dissect that $740 million total revenue figure, the B2B utility thesis instantly evaporates. A staggering 96.1% over $711 million was derived explicitly from reserve income. This reliance on net interest margin, or NIM, is the mechanism by which financial institutions profit from the spread between interest earned on assets, their $73 billion reserve of short-term government bonds, and the cost of capital. They are overwhelmingly a massive, rate-sensitive money market fund.
But that's a historical snapshot. We need to look forward, especially considering the defensive regulatory structure they have built. Their compliance-first strategy, acquiring this immense web of global licenses, is an unparalleled barrier to entry. And furthermore, look at the potential upside from policy shifts. I'm referring specifically to the potential passage of the Genius Act in the U.S. Congress, legislation specifically targeting clarity and regulation for payment stablecoins.
And why is that relevant to the bottom line?
If this legislation passes, it could force a massive flight to quality away from less regulated rivals, chiefly Tether USDT, whose market cap is currently double that of USDC. If regulation restricts the utility of Tether, that massive pool of liquidity, upwards of $150 billion, must migrate to a regulated, compliant dollar stablecoin.
That regulatory stroke of the pen could effectively double or triple Circle's market share overnight, providing a massive influx of assets under management that entirely offsets the risk of moderate rate cuts.
That is the ultimate blue sky scenario, predicated on, uncertain political timing. I agree the regulatory upside is massive, but the immediate quantifiable downside is far more pressing. Let's quantify the interest rate risk you're downplaying. Based on that $73 billion reserve base, the Federal Reserve's anticipated pivot, even a moderate 100 basis point cut in rates, theoretically reduces annual revenue by $730 million.
That's based on a static asset composition.
It is. But let's be frank, a $730 million reduction wipes out the entirety of the Q3 revenue run rate. This dependence on NIM is the structural flaw that makes the 7.6 PS valuation untenable. To put that in perspective for the listener, we are paying 4 times the forward sales multiple for Circle compared to PayPal, a company that has already built a global profitable transaction utility network, which trades at only 1.9 times sales. This premium demands continuous 20+% growth. If that growth trajectory fails, a massive re-rating is inevitable.
We agree that reducing the NIM dependency is critical. That is precisely why management is allocating so heavily to the future architecture, the Circle Payments Network, and the upcoming 2026 ARC blockchain mainnet launch. ARC is not just another blockchain. It's being built as a dedicated enterprise-grade Layer 1 designed to extract transaction fees. Circle will collect toll revenue by abstracting gas fees and processing the millions of USDC transactions that flow through it. This is the explicit path to decoupling their revenue from macroeconomic interest rates. They are making the necessary investment to become a platform, not just a treasury vehicle.
That's a compelling long-term strategic plan, but look at the short-term damage this investment is doing to the quality of earnings. The company recently raised its operating expense guidance significantly, to $495 million to $510 million for R&D on ARC. That is a roughly 35% year-over-year increase. This growth at all costs mentality is problematic because it will massively compress margins precisely when the interest income engine is slowing down.
But infrastructure is never cheap or fast to build. Are you arguing they should cut R&D and simply maximize their current NIM, thereby cementing their identity as a bond fund?
I am arguing they need financial discipline. We have to question the quality of their earnings. The reported net income of $214 million in Q3, which sounds robust, was significantly boosted by a non-operational $61 million tax benefit. When you strip that out and you look at the rapidly increasing OPEX, their operational cash flow stability is much weaker than the headline suggests. I need to see evidence that the massive $500 million spend is already translating into meaningful, high-margin transaction revenue, not just more stablecoin issuance.
How much transaction revenue are you looking for right now, given that ARC is still in development?
If they are truly the Visa of the blockchain era, as the bull case suggests, I need to see a non-reserve income run rate that is substantial enough to cover at least 25% of that increased operating expense. If they are spending $500 million to build this utility, and we only see single-digit millions in transaction revenue, it's just irresponsible spending that will accelerate the margin compression the moment rates drop. That is the leverage trap.
That spending is necessary. Patient capital expenditure required to secure the multi-decade opportunity. True global payment utility cannot be built cheaply or quickly. But let's turn to market mechanics, because the financial volatility you cite has been exacerbated by a tangible, non-fundamental factor: supply.
I couldn't agree more. While the Genius Act upside is massive but uncertain, the immediate market dynamic is dominated by the consequences of the December 2025 lockup expiration. This was a critical supply event that released an estimated 150 to 180 million shares into the potential float.
And the reaction was immediate.
Absolutely. The confirmed insider selling, including significant dispositions by executive management, confirmed market fears that the valuation was too rich. This isn't just retail sentiment. This is a supply overhang that structurally suppresses sustained upward moves. Until that massive volume of shares is absorbed by long-term holders, any rally will likely be met with fresh supply.
I concede that the insider selling created a powerful short-term headwind and rightly worried the market. However, institutional flows tell a profoundly different story. While short-term retail and insiders are selling into the panic, smart money is accumulating. We can track this through quarterly filings. For the listener unfamiliar, 13F data is the required quarterly reporting that shows the holdings of large institutional investment managers.
And what is that data showing?
We see significant accumulation, proving that institutions are operating on a multi-year time horizon. Renaissance Capital, for example, initiated a new position of over 51,000 shares. More importantly, Vanguard established a position of 2.1 million shares. These institutions are not buying an interest rate play. They are buying the discounted infrastructure play. Recognizing the immense barrier to entry created by Circle's global licensure web and compliance infrastructure virtually impossible for new entrants to replicate quickly, they are buying the U.S. regulatory moat.
They might be accumulating, but the technical picture suggests that accumulation is currently happening in a falling knife scenario. The technicals confirm the bear trend. The stock is trading definitively below both its 50-day and 200-day moving averages. These averages act as trend indicators, and crossing below them signals deep bearish momentum. The downside risk remains substantial.
That's an interesting point, though. I would frame the technical picture differently. The massive selling pressure, especially the insider and lockup-related supply, has pushed the stock into technically oversold territory. For those listening, the Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. When the RSI falls below 30, it signals that the stock has been sold off too hard, too fast, which often precedes a sharp, violent relief rally.
Oversold conditions don't guarantee a reversal. They just confirm the severity of the selling.
I agree, but from a short-term trading perspective, we are at an accumulation point, supported by significant short interest. About 10.63 million shares are shorted. The crucial technical trigger that signals a trend reversal is a daily close above $91.30. That is the top of the post-earnings consolidation range. If we close above that level, momentum algorithms flip, and a short squeeze is highly likely, triggering a rapid ascent back toward 110 or 120.
Here, if you're waiting for 91.30, you sacrifice a few dollars of potential gain to avoid the substantial risk of a 15% drop. A break below the key statistical support at 75.63 is highly likely to lead to a test of the 52-week low of $64. That risk is too high given the fundamental uncertainty. Until management demonstrates that the $500 million OPEX spend is translating into resilient, non-NIM transaction revenue, the stock remains structurally susceptible to further valuation re-ratings.
And I maintain that the downside has been largely de-risked by this brutal 70% correction. What we are buying today at $80 is not a stablecoin issuer dependent on Fed funds rates. It is an infrastructure player. It is a powerful call option on the continued dominance of the US dollar in the digital age. The CPN and ARC pivot, validated by massive B2B deals like Intuit, justifies treating this company as the Visa of the blockchain era and accumulating shares while the market still insists on treating it like a regional bank.
The fundamental fragility of the reliance on net interest margin cannot be ignored for the next 12 to 24 months. While the long-term vision of displacing entrenched systems like SWIFT is compelling, the near-term volatility driven by supply overhangs and the high probability of 2026 Fed rate cuts means that conservative investors must exercise patience. Until we see tangible evidence of revenue diversity and high-margin transaction growth, the stock remains a high-risk proposition.
Well, the immense uncertainty surrounding CRCL is vividly reflected in the wide dispersion of analyst targets. Some are at $60, others are at $280. That high degree of risk is precisely the source of the high-leverage asymmetric opportunity.
And the listener must carefully weigh the high-probability, near-term risk of interest rate dependence against the massive, though longer-term, asymmetric potential of displacing legacy global payment systems.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.